What's up? Just waiting on our Instagram friends. There they are. All right, so today is going to be a freaking treat. Today, I just spent, I don't know, several hours yesterday, actually probably the last week, building out a co-living masterclass. It's one of the 3-step process to financial freedom, in my opinion. Really, if you know anything about me, you understand my super investor cheat code, creatively financed deals, capital raising, so you're buying deals using none of your own money, and then co-living to maximize your overall returns, which includes both your cash flow that makes you financially free and your ownership benefits that make you wealthy. So with that being said, I want to test it out. I'm not going to go through all the slides and all this stuff. What we're going to do is we're going to talk about it. And I want you guys to ask questions, insights. What do you think needs to be improved? Whatever. Co-living, ask me any and all of your questions throughout this process. I will have my, I'll be looking at the questions. So keep asking questions all throughout. If you're brand new, hey, Michael Manonskanian, I've gone from 3 properties in 2022 to over $22 million of real estate in the last 3 years, less than 3 years, primarily leveraging the super investor cheat code. I'm literally here to try to help as many of you guys as possible on your path to financial freedom. So with that, today, like I said, we're going to focus on the co-living masterclass. I want this to be very interactive. I want you guys to ask all the questions you can so I can provide even more value to you. And this is one of the 3 steps in my process to financial freedom: creative finance, cap raising, co-living. 3 C's, nice and easy. I dropped the link for my free Wealth Through Real Estate school community. You're more than welcome to join that. And I'm doing 4 webinars at the end of this month or throughout the month of June, which are going to be focused on financial freedom through real estate, mastering deal analysis / co-living, how to consistently get great creative deals and capital partners, and the super investor cheat code. So I'm dropping the link for you to sign up if you'd like. Absolutely free value. I mean, this is pretty epic stuff. Absolutely free value. Dropping a link in there if you'd like to sign up. Otherwise, let's get it going. So the co-living masterclass. What we're going to cover today: why is co-living the best rental strategy? I'll explain that in detail. If anyone knows me, I'm very more so analytical than most people, and I like to explain things, not just foofy feelings. And I love providing affordable housing. I love the benefits of those kinds of things. However, at the end of the day, you are an investor, and there are specific benefits that make the co-living rental strategy the best rental strategy as an investment. And I'm going to break that down in detail for you, just so to help you out with figuring some of that stuff out, or to reinforce what you might already be thinking. We're going to talk about how do you choose a market and a property, right? And then the various costs required to acquire a co-living rental, and then the additional costs for maintaining a co-living rental. So real quick, why it's the best, how to choose a market, and what are ideal candidates, characteristics for properties, and then the cost to acquire and maintain co-living rentals. Man, that's a banger of a, I can't believe I'm giving this stuff away to you guys. It's just so cool. Like, I wish other people did this. I wish other real estate investors went out of their way to provide this much value to people, especially as they're learning, doing, and executing. I just posted on my Instagram, we have 100% occupancy amongst all of our co-living managed on the PropStream platform. We have a few others self-managed, but it's just like, this is the value people need so that they can take things to the next. So once again, the super investor blueprint. Why co-living? It maximizes your cash flow and your ownership benefits. What does that do for you? High level, we'll get into the weeds. What does that do for you high level? Cash flow leads to your financial freedom. Cash flow is that income that you're going to use to cover all of your expenses. That is when you're financially free. When your passive income exceeds your expenses, you're financially free. Co-living gives you more of that, 2 to 3 times more cash flow than a traditional rental strategy. Even more than that, honestly. For the $100 I make, $100 to $500 I make on a long-term rental, I make $1,500 to $2,000 on a co-living rental. Then number 2, creative financing. Why? Because we get to maximize our wealth benefits. Not only is it more scalable that I can buy more properties, because there's less credit, less banks, less all these things, lower entry costs. But because I'm getting properties that are lower interest, typically well, they're always lower interest. I've never bought one that would cost me more interest than traditional, but they're always lower interest. So my tenants are paying down my debts faster. My tenants give me income that I use that to pay the mortgage. I keep the extra. That's cash flow, right? As simply as you can put it. My tenants paying down my debts is phenomenal, especially when the interest rate is lower. More of that money is paying down the actual debt, less is being wasted on interest. Creative finance, if I'm able to buy properties at lower interest rates, that is working in my favor. And if I'm buying properties that have loans a few years into the ownership already, it's already further paying down my interest, my principal of my loan. So I'm paying down my debts faster because they're lower interest rates and usually they're already in process. I am getting more of the appreciation benefits, at least with co-living, because of the fact that I'm buying properties in better markets, better states, better cities, better parts of the city, more valuable properties. And because it's better properties, it also makes it, I get more tax benefits. My properties are worth more, so I get more tax benefits on those properties. And then capital raising. So for me, I raise all the money to buy my deals. The $22+ million of real estate I bought in the last 5 years since I started, the majority in the last 3 years, has been using literally none of my own money. That means I have infinite returns. I have to put in time and effort. I find the deals, I analyze hundreds of deals before I decide which ones are worth buying, right? It's not like I just sit there and just say, yeah, I'll buy that, I'll buy. You have to put in the work, but in exchange for that work, finding the deal and then owning and operating it and having that experience, I am able to raise the money with my partners. So I put no money in, they put all the money in, and I get infinite returns. No matter how much I make in cash flow, I will always have infinite cash on cash returns because I have no money invested personally. I have time and effort, but not money. So my return on investment, my cash on cash return, those are always infinite. So capital raising, that's why it's such a key part of the super investor blueprint, because I still don't have $5 million just sitting in a bank that can then go towards buying a $20+ million portfolio. I needed to raise that money, and raising that through other investors, other people that are interested in getting solid returns on their money or ownership benefits. That's how I've been able to do that. Very simply, my path to financial freedom. Can't get more simple than this. 2018, I started learning, started reading books, podcasts, all that good stuff. Started learning and joined the military at that same exact time. Learning, analyzing deals, chose a market, analyzed deals. After almost 18 months of this, I realized, holy crap, I got to start taking action. I cannot just become financially free unless I actually own properties. I cannot own properties by just analyzing deals. The missing thing, putting in offers, closing on them, and then owning the assets. So what I had to do is give myself an ultimatum. No more analyzing deals unless I made an actual offer on the next one that made sense. I did that. May of 2020, I bought my first property. Over the next year, started doing some cash wholesaling, and I bought a 4-unit multifamily property, used my FHA loan. First time was VA loan as a veteran, or active duty at the time, but now a veteran. And then next time was an FHA loan. So low down payment options, small multifamily properties. And then I started reaching out to sellers directly off market, and I was able to structure 20 rental cabins where I got paid to buy the property that generates me thousands of dollars a month in cash flow. Pretty sick. I was retired at that point. I was financially free. I had nothing else to do. But then I realized that was not enough for what I wanted to do. And my mentor, Pace Morby, really highlighted how it would be really dumb to just take my foot off the gas pedal. And he was right. And from all the stuff that I learned, all the action I've taken, all that, I created my super investor blueprint, right? It's exactly what I share to all of my super investors. We have 70+ super investors that are actual real estate investors looking to scale. If you're just starting out, take advantage of my YouTube, my Instagram, and my Wealth Through Real Estate free school community. If you are a real estate investor that is feeling a little stuck or is not scaling at the speed that you want, you are not leveraging other people's money, you are not buying creatively financed deals, especially efficiently, or you're not buying enough of them, and you're not maximizing your returns through better deal analysis and negotiation or the co-living model, well, then you might be the right fit for super investors. You should already be someone who's done real estate, should have tens of thousands of dollars already sitting there in reserves, because if you're going to scale a portfolio, you want to make sure you have money. Let's talk about it. Reach out to me. But since 2023, I've bought over $20 million of real estate using the super investor blueprint that I shared. All right. So why is co-living so needed? Well, housing unaffordability is only going to get worse. As you know, inflation has been sky high for years. It might be slowing down, but the impact of it has already happened. So things are way more expensive than they used to be, including rental inflation. Interest rates still high as ever, 7+%. Maybe you can pay it down to the 6s, but for investors, 7+% is very common still. And then property prices are extremely high. It's not getting better. And when you see one of the key stats, a key study done by Harvard, almost 50% of people making less than $75,000 a year in income, 75,000 or lower, are paying at least 30% of their income to rent and utilities. So half the people making less than $75,000 are paying at least a third of their income to just rent and utilities. Think about this. Someone who's making $60,000 a year, that's $5,000 a month. They're paying at least $1,500 or more each month in rent. And there's a crazier stat. Of that 50%, 50% of those guys are paying over 50% of their income towards just housing. So housing unaffordability is terrible. It's not getting any better. And who's going to solve it? The government? Do they ever solve it? I mean, I think they always make things worse. It's kind of what we've seen. Or do we want major corporations and hedge funds to solve it? I don't want that. I'd rather have mom and pop operators, smaller operators like you and I. Yeah, I got a lot of real estate now. Yeah, I have an LLCs and all that good stuff. But we're still small fish compared to the big, massive entities that have billions or hundreds of millions of dollars to just throw at things, and they don't really care about their tenants. They don't really care about their properties. I would rather have people like you and I solve this problem, or at least help solve this problem. And in exchange, we also get pretty awesome returns. So housing unaffordability is terrible, and it only is going to get worse. At minimum, it's not getting better, right? Even if it stays the same, it's not getting better. So we said all this stuff. What is co-living? Talking co-living, what is co-living? It's when you buy a single family home and then you rent it by the room. Sometimes you buy a 6, 7, 8 bedroom house and rent that out by the room. You can do it smaller, but I've noticed 6+ bedrooms is where you really start making money, like really solid money. We're talking when we're going at least $1,000+ a month and 15+% cash on cash return. That's when we're looking at 7, 8+ bedrooms, right? It's not very common though to find a 7, 8 bedroom house. It's like, what is that? Like a mansion? I don't know. But it is very common to find 2,000+ square foot houses that are 3 or 4 bedroom, 2 or 3 bath, and then you convert all of the additional living spaces into bedrooms. You're going to keep the kitchen. You might even keep an additional common area, outdoor space. You're going to convert things. What are you going to convert? Well, some of the things you can convert: living room, especially if there's multiple, dining rooms, garages, offices, all these additional spaces that are no longer needed in a co-living model. You convert those into bedrooms. You just use non-load bearing walls, super easy. That's all you got to do. And then I have a supercharged version of this. This is really how I started out when I was in the military. When you're buying these small multifamily properties or house hacking, living in a unit or living in the house and renting out the rooms or the other units by the room, that's literally my first 2 properties. That was very common for what we were doing. That is what I call supercharging it, right? Small multifamilies. Now you're getting even more properties, more units, and even more bedrooms under one roof. Saves you a lot of money that way. Or you're house hacking. So you're taking advantage of a 0% VA loan, 3.5% FHA loan, or 5% down conventional loan. You're leveraging that and the best interest rates you can get, plus additional closing costs, and all these other good things, to then be able to get into a property with little to no money down. And then you're doing the co-living model, maximizing your returns. Right? That's not for everyone, but that is a supercharged version of this. All right. So I have an example of a 7-bed, 3-bath property we have in Atlanta, co-living rental. You can't see it or anything, but I'll tell you about it. Total income. We make over $5,700 a month on this one property, close to $6,000 a month on this property, versus the $1,900 to $2,000 we can make as a long-term rental. We are making 3 times the revenue, not profit, but 3 times the revenue, the total income that we would if we were if we were renting this thing out as a long-term rental. By the room, it rents for around 174 to 206 per week. The bedrooms that have their own private bathroom rent for more. The bedrooms that have a shared bathroom rent for less. If it's on the smaller side, it rents for less. If it's a larger room or more amenities, it rents for more. That's the range in there. And that translates to, what is that? 174, 206. I don't know what that translates to, but around 4.3 weeks a month. So that's around $800 to $900-ish a month for the property. In less than 30 days, we got this thing 100% occupied, and that's very typical. It's not typical for everyone. It's definitely typical for us. Why? Because we care about our properties. We care about our tenants. We're looking at the competition. We're looking at the other properties there, and we are making sure our properties are at minimum as good as the average, if not better. Better amenities, larger beds, larger floor plans, and much better photos and cleanliness, things like that most people are not doing, right? Like they just don't care about the photos. They're taking photos with a potato or something, I don't know, like a Nokia brick phone. We're taking professional photos, or at least a nice iPhone shot, videos, 3D layouts. We're making our properties better. And that's one of the key features of why we maintain a really high occupancy. All right, so let's talk about the pros and cons of co-living. You know very simply what co-living is now. Taking a house and renting it out by the room, and it's not always you're going to buy the house as is. You're typically going to have to buy it and then convert some common areas to bedrooms. But so what are the pros? Much higher returns for owners, much higher cash flow. I just showed you 3 times the amount of income for the same house than it would be for a long-term rental. This, one of the biggest pros, this actually works in more expensive markets. Not only does it work in more expensive markets, it's actually preferred in more expensive markets, and the properties in better markets, especially better properties in better markets, those properties appreciate more in value. They increase in value faster. If it's a larger debt, but at a higher or a better interest rate, you're paying down the debts faster. And bigger property, you get more tax benefits from that. So it works better in more expensive markets, which is great because then you get more ownership benefits. This provides an affordable housing to your tenants as an option that most people do not have access to because it's just not as common right now. We're still in just the startup phase of co-living compared to, think of short-term rentals when it really started getting hot prior to COVID, 2018, 2019. Like, it's been around for a long time, but then it got really popularized. People who bought 5, 6, 7 years ago, they're the ones still crushing it. They're the ones who made massive wealth. You have the opportunity to be part of an investment strategy in its startup phase. And unlike short-term rentals, which have a lot of regulation concerns, co-living does not have those concerns. The one concern are some regulatory ordinances basically saying you can only have so many non-family members in the same house. However, we are seeing state by state by state, local area by local area by local, like municipality, either not enforcing that or literally changing their laws. Oregon, Washington, Denver, these blue states everyone's afraid of, these blue states that tend to appreciate and value more and have better, nicer homes, they're even further encouraging it. Certain areas, Fort Worth, Texas, for example, I mean, there's legal stuff going on right now and all that. It seems like it's going to work well for co-living nonetheless, but it's much less regulation concerns. Why? Because what we are doing is we're providing an affordable housing solution that the local government just obviously cannot do that. That's not what they do. They cannot do that. And what we're doing is, instead of taking away housing, like for short-term rentals that make good money for the right properties in the right locations, but that's taking housing away to provide vacation rentals for tourists. Well, what co-living does is it makes affordable housing of the housing that's there. It provides more affordable housing for those that are actually living there, those that are living there, working there, serving there, people that literally live in these areas, the teachers, the plumbers, the contractors, we have security guards, we have airline employees, all these different things that don't make tons of money, they make 50, 60,000 a year or less, right? That's only roughly like 40,000 is roughly $20 an hour. These guys need a place to live, and they're literally spending. They're making $20 an hour. That's $40,000 a year. $40,000 a year, $20 an hour. I don't know what that is monthly, but $3,000 to $4,000, $3,500. If they're spending $1,500, $2,000 for their one bedroom, they would much rather live in a shared space and save money, especially if they're working a lot. They'd rather enjoy their life, not spend 50% of their income on housing. Is that the case for everyone? Of course not. But this is an option for people that would rather live this way because they want to save so they can actually enjoy their money that they're working so hard for instead of giving up 100% of it to basically just live. Another key benefit of co-living, vacancy is diversified. When I have a short-term rental, a long-term rental, or mid-term rental that is vacant, that sucks because my income goes either 100% or 0%. Either making money or I'm not. It's very binary. For co-living, with a 7-bedroom, let's say 1 or 2 bedrooms are vacant. So we have 10, 20, 30% vacancy at one point, but we still have income coming in. And usually it only takes a few bedrooms to cover your entire mortgage. So at least you have that piece covered. So your vacancy, your income is diversified amongst multiple people. And rarely, except for the very beginning, do you have the whole house vacant, right? It's usually 1 or 2 that are turning over. And when I just looked up our stats on the PadSplit platform, we have tenants that have almost lived there for a year plus. So it's not like people are coming in and they're leaving every 30 days, whatever. We prefer longer stays. And only that, like compared to a short-term rental where you can make the same, if not even more money, but I have multi-million-dollar short-term rentals. I'm not saying it's the worst thing in the world. I'm just saying this is way better, right? That's all I'm saying. I have midterm, long-term, short-term, and co-living rentals. I'm telling you, co-living is my favorite, and it's almost all that I'm buying moving forward because of this. With the rare exception of really cool short-term rentals. That's it. And most people should not do that. It's a whole hospitality thing. You may not have the money or the resources to be able to sustain that I can. But vacancy diversified. Not only is it spread amongst multiple people, well, short-term rentals, if you own a really nice short-term rental, you understand seasonality. Maybe summer you make the majority of your income, but the other 3 months of the year you make a lot less. Maybe you have 2 seasons that are good, winter and summer, but the shoulder seasons are much worse. Well, you have to really be managing your cash flow well so that you can pay all of your expenses without assuming that you have more money than you actually do just because you had a good season. But then now the other 3 quarters of the year, you're making much less income. Where people are always looking for rent by the room. Doesn't matter. As long as you're choosing the right markets, people are always looking for these properties. And then recession resistant. Honestly, people are always afraid when you lose your income. When there's layoffs and economic concerns, people lose income, they lose their jobs. There's a lot less discretionary spending on just extra things, your wants, not your needs. One of those things is traveling for short-term rentals, right? Like people don't need more hospitality stays during that. What they really need is they need lower cost rental options. So it's not only recession resistant that it will sustain itself, it honestly tends to do better. And we've seen that, and it will continue to be the case because housing unaffordability, even if it stays flat, it doesn't get any worse. We're still a far way away. We're like decades away from solving this problem. Whether incomes increase and housing prices stay the same or rental prices stay the same, or rental prices go down, which historically they don't go down, or at least not very much, except for inflated markets. So not only is it recession resistant, what it also is, it actually will do better if the market gets worse. I don't want that to happen, but that's just the reality. But there are cons of co-living, right? It does take more management. Think of the management required for short-term rentals. Think of much closer to that for co-living than a long-term rental or even a mid-term rental. Mid-term rentals, you still have to you still have new tenants come in every 3 to 6 months, but it's a little bit slower. It's a little bit easier. Long-term rentals every year, maybe 2 years, they will renew, right? So it's more management for sure. And there's more expenses, both upfront. If you're buying a property, you're going to have to renovate it to add those extra rooms, furnish it, and you're going to have more monthly costs as well because you're going to cover the utilities. like you would for a midterm or short-term rental. You're going to cover the utilities. If you do what we do, you're going to cover certain common area expenses. You're going to cover certain things like for us, send out a cleaner for certain properties. It's going to be more monthly expenses, not nearly as much as short-term rental where people are moving out every couple of days. We have people that are staying multiple months, if not a year plus. So it's not like you're always having more management or more costs, but the reality is that is a con. It's a higher management strategy than a long-term rental. One thing is these are people living in our house, and people are people. Humans are humans. So you have diverse tenants, right? So there might be issues that arise. It's very rare that we honestly have tenant issues, but nonetheless, you have to understand that's a reality of it because you're putting in multiple people in the property. One of the questions being asked, what's the average number of tenants you look for in one property? We tend to have ideally no less than 7, right? We have properties, the properties that have less, we've sold, right? That's when I started out. My first time getting into co-living was a short-term rental that did not pan out as well in Atlanta, Georgia. We decided to list it on PadSplit and got it rented 100% almost instantly. I realized, okay, this is a great model. This is just not the great property for it. It's too small. It was good. We went from losing money to making money, but it wasn't enough money to make it worth it. I sold it to someone focused more on tax benefits, let them take over our management and just take over, enjoy the property. But then that was the concept, was at 6, we're starting to make some good money. At 6, we're starting to make like the minimum money that I want. 7 plus, that's what, like 7 to 10. You don't want really more than 10. You can do over 10, but understand it's just a lot of people in one house. That 7 to 9 is the really solid spot. In theory, every property that you're at, every room you're adding, you're making more money. But there's you also got to make sure you have enough bathrooms and it's a large enough home for that. You don't want to cram too many people in a house. That is going to potentially cause issues and turnover, right? Even if it doesn't cause issues, if it's too big of a house, too many people sharing a specific bathroom, that is going to cause issues. And then like I mentioned, there are regulatory ordinances. There's less regulation concern in the sense of no one's really cracking down on this. Very few areas are. And the concerns that are out there are just not that big of an issue, right? Because we're providing a solution to the area that the government cannot. No one wants to be the champion of slowing down co-living rentals. I guess outside of some submarkets in Texas, ironically enough, free state. But it's not like short-term rentals where it's very easy. Even if it's not true that it's taken away all the housing and that's why people can't afford to live there, it is very easy to make that the boogeyman, make that the scary guy, say, we need to stop this thing. Because you're saying, hey, we're increasing housing prices to create vacation rentals for people who don't even live here. Well, actually, we're taking houses, we're making sure that's sustainable, like they're getting paid and all that stuff's good, and we're providing more affordable housing to the people that need it the most. It's pretty awesome. So you need people to champion regulatory changes. It's going to be very hard for people to say, hey, we need less of this thing, right? And then those existing laws focused on, typically it's 6 plus non-family members living in the same house. Those are not regularly enforced. And those are the ones that are pretty much being changed. Like I said, I mentioned several different states that are going full force in this, and it continues changing, not daily, but we'll say monthly. It continues being more and more advantageous for co-living. All right. So very simply, the 5 ways that you benefit through real estate investing in general. And then I'm going to talk about why co-living maximizes all these. Cash flow, your monthly profit. Appreciation, which is your property value increasing. Debt pay down, which is your tenants are paying down your debts for you. You're paying down the principal balance of your loans. Tax savings you get through depreciation of the property. So the more the property's worth, the more depreciation tax benefit you get. And interest payments on your loans are also tax deductible. And the 5th one, not very many people talk about, is not as tangible, but I call it leverage. And leverage is the more that you are doing, especially when you're doing asset classes, like working asset class people prefer, then you get the ability to raise more money, right? So the better the returns on the property, the more momentum you build, the more you can raise money and build and scale your portfolio faster. And as you get more and more real estate, you can then leverage and hire people like I've done, virtual assistants, operations manager, asset manager, have fractional services that come in and provide value to my business as a whole. And that's through leverage. And then why is co-living the best rental strategy? Well, you get 2 to 5 times the returns that you get higher cash flow. So 2 to 5 times the returns, definitely compared to the cash flow, to a long-term rental. Higher appreciation, right? So you're buying in markets that are better states, better cities, better locations, bigger properties. Those tend to appreciate more than the 5% annualized average of appreciation. Higher debt pay down. You have these larger debts, especially when you combine it with creative financing, so lower interest rates. Larger debts at lower rates, they're getting paid down faster. Higher tax benefits. The larger the property, the more renovations that you do as well. All that is tax deductible. Once again, leverage. If a property is getting better cash flow, better ownership benefits, then the easier it is to raise capital on that, especially when we're talking about something that is trending. I don't know about you, but when I go to these real estate meetups and events, co-living, I don't even think of myself as the co-living guy, but a lot of people do. Part of that is I own probably more than the majority in the sub-2 community that I'm part of and a leader in. I do own a lot of co-living, but I think of myself more as finding great deals, mastering deal analysis, raising capital for those deals. It's really about the acquisition, because I'm not a management strategy guy, because we do lots of different things. However, I get it. The majority of what I've bought over the last couple of years is co-living. So I get it. I get why people think that. It's trending. People think of me as that, and it helps everyone. People, especially in the super investors community, have raised millions and millions of dollars, multiple millions of dollars this year alone to fund over 100 co-living rental units just in the first 6 months of this year. And we just started Super Investors. It's pretty freaking amazing, actually. We have one of my guys, Aaron Lambert, right now just has raised 150 of his $200,000 for a phenomenal co-living rental in Florida. You don't know him? Reach out to him. But part of that is higher cash flow, way higher cash flow, which equates to higher cash on cash return, as long as your entry cost makes sense, higher ownership benefits, and then they're part of something incredible, which is what a lot of people want to be part of. Co-living is phenomenal as an investment, but it's also phenomenal for what solution we're providing. We are creating more affordable housing, helping people who need that help financially. Like I said, one of the sixth bonus just hit the nail on the head. We're helping solve the affordable housing crisis that we can't trust the government and we don't want corporations to do. I have a very simple example. It'd be easier if I just shared it. Maybe I will just share it. I'm going to screen share for a second because it'll make it easier. But it's how I'm getting higher cash flow from my co-living rentals. There we go. I'm going to share one slide. All right. So screen share. Boom. So this single family rental, this is one of the properties that I own in Atlanta. Single family rental would make around $2,000 a month. Maintenance, you take around 10% of that, right, for maintenance. $195, no utilities, you don't cover anything. You're good there. You don't have to cover any of that. $200 management, so around 10% of the monthly income is going to management. So your net operating revenue, this is not accounting for debt payments or anything. This is income minus the expenses, not mortgage payments or anything like that, is $1,600. Co-living, same property, it's actually being rented out right now, makes $65.50 a month. This property makes $65.50 a month. Let me see if I can actually have some pretty good notes on this property because I want to provide maximum value. I went and pulled up actual stuff. The maintenance is around 6%. So it's a higher dollar amount, but it's a lower percentage of your income because at a certain point, it's not going to be that much more. We're already talking about 2 times the maintenance cost, even though it's a smaller percentage. Our utilities, yes, we're paying utilities now. So this instance, 565 utilities, water, sewer, electric, internet, that kind of stuff. And the management is higher. It's a higher percentage and it's a higher dollar amount because it's a higher income, right? It's a percentage of the income, $785. In this specific instance, a property that would generate $1,600 net operating revenue and lose $400 a month as a long-term rental instead makes $4,800 a month in net operating revenue. This thing is making, what is it making? Close to $2,000 a month in profit as a co-living rental, as a 7-bedroom that averages out to around $935 a room a month, 7 bedrooms, which then it's around $215 a week average. The mortgage on this one's around $2,000. It was a $450,000 property, loan at 3%, $405,000 loan. And between taxes, insurance, and all that, we're paying around $2,000 a month. This property is making over $2,000 a month or close to it as a co-living rental that would be losing money as a long-term rental. Plus, we have more ownership benefits as well because of that. We get much larger ownership benefits because I can buy a $450,000 property in a great area that then increases and appreciates more in value than what like a long-term rental that would not that would be losing money. Like the best long-term rentals are small properties in small markets, 2-bedroom, $80,000 properties or less in markets that don't appreciate much. So yeah, maybe you'll get $400 or $500 of cash flow. Maybe even get 20% cash on cash return. Great. We are missing out on one of the biggest benefits, which is also the ownership benefits, appreciation, debt pay down, taxes. For every dollar I make in cash flow, on average, I make 5 times that in ownership benefits. So my cash flow is what makes me financially free. My ownership benefits is what makes me wealthy. It's an incredible duo. And I can, when I sell those properties or refinance out of those loans and pull money out, I will have that money tax-free to do something with. I mean, if I sold it, it would not be tax-free. But if I do a cash out refinance, I would be able to do something with it. Or I do a 1031 exchange where I sell it, but then to buy a bigger, better property, I would be able to do something with it once again without paying taxes. So the higher returns, the higher cash flow provides you a faster path to financial freedom while also helping the community with more affordable rentals. The cool part, right? Co-living is more profitable than long-term rentals and midterm rentals. And it might be similar, right? Not this property, but certain properties might be similar in income. However, in my opinion, and with our scalability and our team, co-living is way easier to manage, less regulation risk, and less rental volatility than a short-term rental. All right, with that, I don't think I need to share much more screen. Let's get back to it. All right, so how do you choose a co-living market? Well, one of the big things that you keep hearing me say is market unaffordability. You need to focus on markets that are more expensive for people to rent than the amount of income they're pulling in. For example, comparing the prices of studios and 1-bedroom properties to the average salaries in those areas. Markets that have a lot of salaries at $60,000 or less are preferred because $60,000, right, is $5,000 a month of income. Well, it's very hard to find rentals under $1,500 a month in any major metro area, major market. And once again, anyone under $75,000, on average, 50% of those guys are spending 30% or more of their income on rent. So if you can, those are the areas that make the most sense to provide affordable housing like this. Next, you're going to want, co-living does not work very well in low-cost markets. I mean, there might be some that it does make sense, but typically, if it's a not very expensive to rent out a place, then it doesn't really make sense. Why would someone rent by the room for $600, $700, $800 a month if they could just rent out a studio or a 1-bedroom for $1,000 a month? Or, you know, it's got to be some kind of discrepancy in rental income. So the lower the cost market, the harder it is for that to make sense. It's ideal when there are more low income type of workers, employees. For example, like I said, some healthcare professionals, we have college students, military, we have people, airlines, like we have all of these different things. Just people, I mean, the majority of people are making between $20 to $30 an hour or less than $30 an hour. Those are the people that are then making less than $60,000 a year. All right, so other ways to choose a co-living market. Well, major metro areas are definitely preferred. Big states that have bigger cities are preferred especially those that have favorable occupancy laws. Doesn't mean that they say, oh, we're full force like Denver, like Colorado or Washington or Oregon says, yes, please just do whatever you want. Bring as many people in. Like as long as you're managing your properties well, you're good. Maybe they're not like advocating for it, but it's also those that allow it or do not infringe on people's ability to do so. This is one of those where like Atlanta makes a lot of sense. And I'll tell you one of the tools that I use, once again, I'll screen share for this one. Pad split. It's literally the ultimate cheat code is pad split. They literally have a map for you that says, here's our core markets. Every blue market is a core market where they have existing co-living properties. They say we have properties here, Atlanta, Georgia being the one where they started, and gray emerging. Look at all these markets. When I started this thing in 2023, this was not at all what the map looked like. Even at the start of this year, the map didn't look like this. Majority of 2024, it did not look like this. So it's continuing to expand and grow, which is incredible because this is what I'm saying. It's better to jump in earlier, take advantage of this investment opportunity. You don't even need creative financing. You can just go buy properties using a DSCR loan or the traditional way. As long as they hit your financial returns, do that. Incredible. It doesn't really matter as long as you're getting the solid returns you need and you're buying these properties that make financial sense for you to do so. Yeah, I mean, there's like the majority of key states are on here, right? You're not going to see much up here. Definitely, I wouldn't expect anything in New Mexico, but look at all these major cities that rarely have worked as great rentals. And now you can make it work, and not only just make it work, get even more returns and cash flow, get even more cash flow and better ownership benefits. If you don't know how to get this map, I got you. I'm dropping my link. It's absolutely for free. You can go in and you can leverage the pad split tool to then be able to get access to this map absolutely for free. They just give it to you. Not only do they give you this map, you can click on any of these markets on the map. And what else does it give you? It literally tells you the number of active units and the number upcoming, right? So how many they have currently and how many more are coming in this area. You can even go zip code by clicking these individual ones. It tells you in the last 30 days, almost 40,000 people have been searching, and they're still early, right? It's still less than 10,000. So over 4 times the amount of people have been searching for these rentals on the pad split platform compared to the amount that are available. This is such a cheat code of data that was not really available up until last year, pretty much. I mean, it was there, but there just wasn't enough data. There's a lot more data now. You wonder, well, how much can I rent this thing out? Well, it tells you how much do rooms with shared bathrooms rent out for? How much with private bathrooms do they rent out for? Yes, you should still do your due diligence. Don't just take this at face value. Go and look at the zip code by zip code. Go look at actual properties by street, wherever you're looking, because even by street, it could vary a bit. I just had a property where that was the case, where the specific area we're looking at was closer to the 170s, where some of the comps that are skewing the income higher than it should be are in the 190s, and they're just in a different part of that same zip code. Go on Zillow. They share data now, rent by the room. There's other tools and platforms as well that share this, but pad split is the number one that I reference for all of this data. Tells you average occupancy. 89% of the rooms available are rented out. That's insane. That's incredible. How long to get your first booking? How long until around 80% of the property? Every 5 bedrooms? How quickly do 4 bedrooms get filled out? Typically 30 days. Like I said, in less than 30 days, we go 100%, right? However, that's not the case for everyone. It just depends. That's why it's important to understand what the properties look like, the photographs, your competition, so that you can provide a better product, so that your product, your rental, is the one that gets people to stop, to look, and want to work with you. All right. And you can, like I said, go zip code by zip code. You can literally just go look at these major markets, choose your market. I call this kind of the reverse buying process, right? I need to figure out a cute name for it, but it's like you hear reverse wholesaling, which is kind of, hey, I'm going to go talk to buyers first. And then what I'm going to do with those buyers is I'm going to then find deals that make sense for them. That's the reverse wholesaling. This is kind of the equivalent of what I call reverse buying. I'm not trying to guess and check or I'm not trying to like just pick like randomly or have like, oh, this is my local market. I'm literally going off the data that makes the most sense and then choosing what I want to buy based off that, and then finding the investments that make sense for what I want to accomplish. Not just saying, I'm going to buy, this is my buy box randomly. It's all data driven. That is the way that you should be investing. Data driven to get you the highest returns that you can, because the more returns you get with the least amount of properties in the shortest amount of time frame, the faster you are financially free. That's literally the goal, right? Your goal is to not do this thing for 50 years. If you can do it in a few, you should definitely do it in as few as possible that you can, right? I mean, it just makes logical sense. All right, what do we have next? All right, so we talked about the markets. How do you choose a market and where you get some of that data from? But what types of properties make the most sense for co-living? Well, I'm going to hit this. Location is key, right? It depends on the market that you're buying in, the state, the city, right? And then the submarket. So even in that city, there are different zip codes that have better returns or they perform better, and that tends to make sense. Properties that are in more blue collar areas where the average income is not like so low, like you don't want to go where it's like extremely low. Like a lot of my tenants are young working professionals, people that just they make, they make typically over 40K a year, but they don't make much over 60. They're like that 40 to 60 range where they don't want to spend all their money, but they do have disposable income. They're not like completely on the lowest end of the spectrum financially. However, they don't want to dedicate 50+% of their income towards just rent. So property sizes. The goal is to have at least 6 or more bedrooms. Like I said, 7+ is really that sweet spot. 7 to 9 is phenomenal. However, very few times will you find properties with 6+ bedrooms. What you want to account for is a larger property will tend to do better, especially larger properties that have a very efficient way of the layout, the floor plan. So at minimum, I look for 3-bed, 2-bath minimum. I don't really care about bedrooms, but as long as it's got at least 2 bathrooms, I set the minimum to 3 beds, because even if it's a big house, like it really depends. Because there are some weird, like the best properties are those weird ones. 3-bed, 2-bath, 4-bed, 2-bath that have like 2,000+ square feet. Cool. That means they have multiple living rooms, dining rooms, offices, basements. They have all these extra square footage that can then be converted to bedrooms, even though when you look on when you look on Zillow or whatever, it's not going to show you that there's a ton of bedrooms. Well, it's fine. We convert into bedrooms. So the bedrooms is somewhat there as a filter, but it's really those bathrooms. Why? Because Pad Split has a rule. They don't want you to have more than 4 bedrooms sharing 1 bathroom. That makes logical sense, because at a certain point, it's almost impossible for people to do their morning routines, go to the restroom when they need to. You're going to have a lot of turnover. It's going to be uncomfortable for them. That 4 bedrooms to 1 bath ratio is basically the minimum that you want, or the maximum that you want. Ideally, 3-bed to 1 bath is solid. Sometimes you're going to have private bathrooms, so it's like an ensuite unit. So the bedroom and bathroom is private. Awesome. So for property size, larger the property, the better. Square footage for me is more important than bedrooms, but I want at least 2 bathrooms or more. Can you add bathrooms? Of course, but it costs a lot more money, and that's where you lead to more issues, especially because the bedrooms do not necessarily have to be permitted. I'm not saying legally they shouldn't. It's up to you and your risk tolerance. However, one thing to understand is that adding some non-load bearing walls, there's not a lot of concerns. But with bathrooms, you're adding more to the septic system, like to septic and sewage. You're moving water around. There could be more things that go wrong. Those should be permitted. It's up to you ultimately. It's up to your risk tolerance. Nonetheless, there's not a lot of risk adding some non-load bearing walls to create more bedrooms. There is more for bathrooms. So the more bathrooms, the better, and the larger the property, the better. I don't really care as much about the bedrooms. As long as it's a big enough property where I can convert spaces into more bedrooms. You need parking. One of the biggest things for a co-living property that we filter out, like why it doesn't make sense after location and property size, is parking. You need to have ideally a driveway, right? So there's a few cars can park there, especially those that have like a driveway that goes to the back that you can have parking in the back, and then street parking available. You don't really want your tenants parking in front of other people's houses. So those that are in a corner are the best, because then you have in front of your house, you have your driveway, and you have the side of your house. Or those that are the way the like setup is that your neighbor that like there's parking on the sides of the house, on the side of someone's property, that's fine. Parking in front is not ideal, like right in front of their house where their door is. On the sides, as long as it's available and it's just the side of the house, that's awesome. So when you have a corner, you kind of get all those benefits. The driveway in front of your house, to the side of your house, and even to the side of your neighbor's house, as long as they're not inconveniencing the neighbors. And for me, I don't buy any properties with HOAs. Why? Because HOAs can quite literally tell you, maybe they don't have a rental restriction in their CC&Rs or their regulations, but they will make it a hassle for you when you have multiple people parking in the driveway or whatever. They will find a way. If they want your house not operating as a co-living, they will find a way to complain or make issues that will cause a huge deal for you. And now this property that you invested in, renovated, and started renting out, now you got to figure out an exit plan for it, and you do not want to do that. So the best thing, just avoid HOAs. That's one of my rules. Some people crush it and they dominate with HOAs. That's not something I want to deal with at all. I want simplicity and convenience. One of that means is not dealing with a bunch of people who are spending their, 3 p.m. on an afternoon having a meeting to then decide my rental strategy doesn't work in their HOA. All right. So to understand, like I said, like rarely are you going to find a property that's 8-bed, 3 or 4 bath that crushes. But you will tend to find that 3-bed, 2-bath with a lot of square footage. And your job, you're going to have to do renovation. That's almost a guarantee to have these properties crush, or at least especially if you want more deal flow available to you, right? You can wait for the perfect 8-bed, 4-bath house, but it's not as common. I just want you to understand that. So the larger the square footage with an ideal floor plan is preferred, because then what you're going to do is you're going to convert your common areas to bedrooms. You don't have to convert all of them, but if there's living rooms, dining rooms, offices, garages, those are very convenient to convert over to a bedroom. Garages are more costly than like an office, dining room, or living room, or interior space, but that's another way to get more bedrooms. You're going to add some non-load bearing walls to close off these rooms. So if it's a living room and it's got one open, you'll close that off and put a door there. If it's got 2, cool. You'll close off 2 walls and add a door there. And then it's up to you. If you're going to add permanent closets, build them in, do some pop-up closets or like an armoire or something like that. It's up to you what route you want to go for the closets. But the less permanent, the better, because at some point in the future, I mean, you're going to own this thing for a while because you're going to make great returns on it. But in the future, you're going to probably want to get rid of those. The less that you have to spend money on removing, the better. And like I said, the 4-to-1 ratio is the max. 3-to-1 is preferred. And I mean, the lower, the better, right? In theory. However, rarely you're going to be able to, I know some people who are doing full renovations and making it 1-bed, 1-bath or 2-bed, 1-bath. That's awesome. But it's not common if you're buying properties the way a lot of us want to for scalability, buying these creatively financed, great debt deals, great interest rate deals with lower costs and much lower renovations. You're not going to have, 1-to-1 ratio or even maybe a 2-to-1 ratio. That 3-to-1 is that solid spot you want to get to because 3 people can share a bathroom fairly conveniently. 4-to-1 is when you're really pushing it. Having a few 2-to-1, 3-to-1, that's solid. And you're going to tend to have some 1-to-1 as well. So what are the costs to acquiring a co-living rental? Well, your property acquisition costs are the same. If you're buying a house, you're buying a house. Whether you got a down payment, an agent involved, a wholesaler involved, and closing costs, you have those costs nonetheless to acquire the property. That part's not changing. But the parts that are additional, well, you have additional co-living costs are going to include, you're going to renovate the property. You're going to take those bedrooms and make more of them, right? Or take those common spaces and make more of them. You're going to furnish the property. It's up to you if you furnish the bedrooms. We don't do 100% furnishing like we would a short-term rental, but we furnish them to at minimum the standard of the market, if not a little bit above. Some of our bedrooms, beds, mattresses, a desk, nightstands, those are the common ones. I've heard people adding like mini fridges. If no one's doing that in your market, then you could do that to maybe have an advantage, but it's also not standard and it may not be worth it because now you're adding more to the electrical load and all that stuff, whatever. But we try to at least meet the market, if not exceed it. And typically a bed, queen sized at least, a desk and a nightstand are a solid way. Those are solid amenities for your tenants. And then property reserves. You want to make sure you have at least a couple months of mortgage payments and expenses set aside when you're acquiring your property so that you do not end up screwed. You do not end up screwed over if you don't rent out your property fast enough. Like I said, we just saw Atlanta. It said 80% of the house is filled within 30 days. We're at closer to 100% within 30 days. Does not mean that's always the case in every market and for every operator. So just be cognizant of that. Have some reserves set aside. At minimum, you'll at least have some of the rooms filled up. So at least you have some income offsetting your expenses. If you want to have those reserves saved up, especially if you're raising money to buy these deals. I will do my final slide because I'm going to show you the additional costs to maintain a co-living property, and it'd be easier just to actually show you. This is like your monthly cost, right? We talked a lot about the upfront costs. What about the monthly costs? And that present. Cool. So you have your fixed expenses, right? If you got a mortgage, you got all that, that's here, right? That's your fixed expenses. If you're doing a rental, you're going to more likely pay more in insurance than what was already there. If you're buying a property traditionally, this is just part of your fixed expenses, your normal insurance. If you're buying something creatively financed, especially subject to, right? You're going to have additional insurance costs because whatever the previous homeowner was paying is probably lower than what you'd pay. But the real things, utilities, water, sewer, gas, electric, garbage, internet, Wi-Fi, if you're covering landscaping, house cleaning, if you're providing any shared supplies, toilet paper, paper towels, trash bags, things like that, that's like no one person will do. Some of our houses, they just figure it out themselves and they do it. We don't even tell them how to do it. They just do it. Something we just supply those things up front to minimize that. And then if you're paying property management, well, PadSplit is not a property management provider. And I'll talk a little bit more about that. What they are is the equivalent of Airbnb to short-term rentals, right? And I'll really explain that, but they have a fee for using their platform. And if you are self-managing, maybe you want to get paid for it. If you are outsourcing it, there's going to be additional cost. Typically, you can just, if you're paying a property manager, you can have them do it without the PadSplit platform. Let me try to remove some of this stuff so that it's not blocking your view. There we go. The PadSplit platform, they have a fee associated with it. But if you have a property manager that's just doing it separate from there, cool. You just pay them a specific fee. Get rid of this, send that to 0. And then that is just the property management fee. Just increase that to what's correct. Or you have PadSplit and you're either self-managing or outsourcing some of this management. These numbers are going to depend on your market more than anything else. Another benefit of PadSplit, well, they have these resources for you in the markets that they're operating in. And then you want to account for your reserves for vacancy, maintenance, and capital expenditures. You want to account for those things as well. All right, let me show you quickly about PadSplit. So PadSplit's management, right? Like I said, they're the equivalent of what Airbnb is for short-term rentals. They help you find tenants or what they call members, right? They're not tenants on the PadSplit platform. They are members of the PadSplit platform. They help you manage guest communication. So it's all through the platform. I mean, you still have to be the one to communicate, but it's through the platform. So it's all in one space. You don't have to text or all this. It's on their platform. They manage the rental income collection, right? They literally, people submit their payments in there and then it comes to you afterwards. And they handle the leases, but they're not leases. They're the memberships that they offer to the members that live there. It's all very specific why it's all phrased this way. But you still have to manage the tenants. When tenants are moving in or out, that's on you. You or your team has to manage that. When you're sending contractors out or handymen, well, that's on you to manage that. Once again, if you want to understand how PadSplit works, it's completely free to set up an account on there. And if you're looking at my calculator and thinking, wait a minute, how did this guy, like, where did he get that awesome analysis? Well, I give all that away. I give literally all that away on my buy box page. I give it all away, all my tools, my calculators. I mean, there's certain versions that are exclusive to my super investors, but there are a lot of tools and resources that I provide absolutely for free as well in my Wealth Through Real Estate community. I just dropped a ton of links for you guys because I want you to succeed. I want you guys to know to who I'm talking to for Wealth Through Real Estate is where I was at 5 to 7 years ago when I was just starting out. Who I'm talking to in super investors is I have a few properties. I'm looking to scale now. I need to do this thing bigger, better, faster so I can be done doing this for the rest of my life. I don't want to do this for 10, 20, 30, 40 years if I don't need to. For those of you guys who are just starting out on the beginning of your journey, maybe more focused on active income or learning, I've got Wealth Through Real Estate for you to help you out. For those that are real estate investors that are looking to scale, Maybe you only have a handful of properties and you have some reserves set aside, a couple 10, 20, 30, $40,000, but you're looking to scale now. Cool. Let me help you through creatively financed deals, through raising capital, and through actually implementing co-living more successfully. And so that is what I share with you guys. And Wealth of Real Estate, what I wish I knew 5 to 7 years ago, the type of community that I would have liked to have had when I started out, and then super investors for those that are actually looking to scale their portfolio now. So hopefully that provided a lot of insights. That was the end of this training. I've given away literally pad split resources that I use. My buy box, you can get very clear on that. Wealth of Real Estate, give you free access to trainings, tools, and resources. And I'm my calculator. I mean, all of it. I'm trying to help you guys out as much as possible. Please, if you got some value in this, please drop some comments, reach out to me, let me know, tag me in something. I'd love and appreciate that. I'm going to just quickly hit a few questions that I saw come in. Occupancy, we're currently 100% occupied with our co-living rentals. Obviously, we were on a dip because every new property we add is fully vacant, and then 30 days later, it's rented out. So we're back to 100%. So we added a couple properties. Luke said, how can we change the laws? I don't know how you're going to change the laws. I'm not the one who changes the laws. Usually the regulatory people who are there change the laws. That's not my job. My job is to buy and hold real estate in markets that are favorable to me as a landlord, not trying to change the laws in markets that do not want me to be there, right? I'm not trying to change the laws. I'm trying to work and operate in markets that want me to succeed in their markets. They make it easier for me to be an owner, a landlord, and to do this co-living model. Kat said we need co-living in my area. DMV, absolutely, and they have it in their area. They're opening up. That's very expensive. People ask, do I manage it or hire a property management company? So I used to use property management company. Between pad split and scaling my portfolio, I've hired virtual assistants to help with the guest communications and all that. Plus I have an asset manager now, but I own 70 plus properties, hundreds of room rentals. You don't need to worry about that as much when you're starting out. Outsource the property management. Once you're paying tens of thousands of dollars like I was for property management, then bring it in-house, pay someone else to do it and do a better quality for your portfolio as a whole. That's part of your journey. If you're asking that question, if it's your first one, outsource it, right? Or self-manage it with pad split. Pad split has resources for property management companies in most of the markets that they're operating in. But if you are asking that question, you already have some properties and you're looking to scale, that's a super investor type question. That's how I help you. That's how I give you the roadmap of exactly how I've scaled my team. When I've hit certain levels as I was scaling, what is it specifically that I hired for and what is the roles they specifically did every part of my business? All right, y'all. Appreciate you guys. Thank you. I think, does that mean the master bathroom is shared with other room renters? No, if there's a master bathroom, that's going to be part of the master bedroom. If there's no easy way to make access to that, it'll probably be just a individually used by the master bedroom. And those rooms tend to rent for much higher than the ones with share bathrooms. Average number of tenants. Yep, we answered that. Average number of tenants look for on a property. I'm looking for at least 6, but 7 plus is really where I'm looking for at least $1,500 to $2,000 a month of cash flow and 15% higher cash on cash return. To get that, I need to be in that 7 plus bedroom area. That's really what it is. Perfect co-living in Tampa. It's already a 7 bedroom, possibility to add 2 more bedrooms. Would I be interested in helping and working together? Yeah. Send me that deal. DM me on Instagram at Michael MNAT. G said, let's work together. Let's see. I do a lot of that. Oh, someone said, does it matter if the property you buy for co-living is close to public transport? It used to matter more. It depends on your market. Yes, some of our tenants are using public transportation. The majority of them have cars. So it's ideal if you're close to public transportation and you have parking space. But the reality is the majority of people have a car. Maybe not a fancy car, expensive car, but they have a car to get them to and from. Especially like Atlanta, yeah, it's cool to be near public transportation, but most people are driving to work. Like that's the reality of it. So parking for me is very important. All right. With that, thank you guys. I'm late to a meeting, but I wanted to provide as much value. If you need more benefits, if you're where I was when I was starting out or just getting a few properties, like just starting to get properties under my belt and learning and taking action, Wealth of Real Estate is your community. Please go get so much value from that. Free courses, tools, resources, all these amazing things. Because my YouTube is more in depth. I'm never going to get a bunch of views, but I will provide you a bunch of value on my YouTube. And that's all I care about. For those that are real estate investors looking to scale, to financial freedom more quickly through leveraging more advanced strategies, that's super investors. I already hit the 3 C's, right? My cheat code, it's not the only thing that we do, but creatively financed deals does not mean I don't buy properties traditionally, but creative financing is better, especially for scalability. Capital raising, I know I don't fund properties using my own money. So this is kind of the non-negotiable. Creative financing is not non-negotiable. Co-living is not non-negotiable. Using other people's money, raising money to buy deals is a non-negotiable for me. So if you want to get better at that, raise millions of dollars like various other super investors, raise millions of dollars like I've raised for my personal deals, this is one of the biggest benefits you can get there. And then co-living, really understand it on a much more deeper, more intimate level so that you can scale your portfolio more quickly. That's what super investors is about. So with that, thank you guys. Have a blessed day. And super investors, I will see you tonight for an incredible training that we have.